Hard to have a bad day when you are live on Facebook for the Not Your Average Investor Show Thursday edition. Welcome, everybody. I am your host, Pablo Gonzalez, my amazing co-host and world-class beach runner, Gregg Cohen. Welcome, Gregg.
Hey, buddy. Hello, everybody. Good to be here.
So today is Thursday, right? This is our intimate, completely viewer-driven Q&A show. And we have a little bit of housekeeping that we always go into. The first one is that we always want to interact with you. So if you are in the Zoom room right now, like Lee Bishop and Bill Shields have done, that you're commenting to us, you want to hit that blue button in the chat and drop and put all panelists and attendees so everybody can be talking to each other. Lee, thank you for the compliment on the fact that my microphone now works better. I appreciate it. And we can continue to play this game. And if you want to ask us questions that get asked live on air, hit the Q&A little button on the bottom right and pop that box open, put the Q&A in there. It really helps me keep track of everything and then be able to follow up with anybody's questions that haven't been answered from the week prior, because I send people your way if we don't get to it. And apart from that, if you want a primer on all things rental property investing and you want to really understand what it's all about, I suggest you go to jwbwebclass.com, where Gregg took an amazing afternoon of downloading his brain into a class that's going to help you understand what to look for in a market, what the benefits are, what JWB does better than everybody else in the world. And if you're ready to take the next step, or you're thinking you might be ready to take the next step, you want some personalized advice, go to chatwithjwb.com, pick out a time that works best for you, and hop on with our team. So, Gregg, you ready for our Q&A on Thursday?
It's about that time, brother. Let's get into it.
It's about that time. I wanted to talk, Gregg. We've been hearing from the sales guys, the mics, that when people call to find out about rental income properties, that they say, oh yeah, Florida, I'm thinking about Florida, this and that. But, we believe that Jacksonville is different than the rest of Florida, because it is. And I just kind of wanted to go through with you what the difference is between investing in Florida and investing in Jacksonville. And the first thing that I want to ask you about is, at what point, at what population size does it make sense to invest in a city for rental income properties, in your opinion?
Yeah, you want to be in a city that has at least 1 million people in it. And the reason that you want to do this is because you want to have a diverse population, and you also want to have a diverse job base, right? You don't want all of your jobs being with one major company, because if that one major company decides to make a change or something happens, there goes a significant portion of the economy. There goes a significant portion of how your residents are going to pay rent. There goes a significant, downturn to the model that you're investing in. So, keep that in mind when you're considering a market. That it's very easy. Just look up their population. Need to have at least 1 million people. Jacksonville has 1.5 million, which is great. Been growing tremendously, especially over the 15 years that I've been here. But yeah, over 1 million, we'll be in a good spot for you.
Okay, excellent. So when I hadn't thought about the diversity in hiring people, right? So over 1 million already rules out a lot of the average Florida town that is developer driven, and they're building these huge subdivisions and stuff like that and renting it out at mass. But I think of Gainesville, which is right down the street. Our beloved Gainesville, Florida, where the University of Florida is, right? And I remember coming out of school thinking that it's a good idea to invest in student housing. And this is before coronavirus, before the idea that there are no students in Gainesville right now, or at least very few. But what do you say to the person that is debating between investing in Jacksonville or in a college town like Gainesville that will always have students and turnover and stuff like that?
Yeah, let's take coronavirus out of the equation. We can kind of lump in vacation rentals. We can kind of lump in student housing. These can be great strategies to be able to make a great return in rental property investing, right? There's a million different ways to be able to make money in real estate, and these are some. But you got to go back to why you're investing. What are your priorities? For our clients, for me personally, it's got to be this passive income stream, right? It's got to be able to generate the best risk-adjusted returns, but it also has to be able to generate those returns in a way that it doesn't take time away from me for my family, for my career, you know, all those things. That's what our clients want. So what I would say about student housing, and, you know, obviously it would be easy to take a shot at student housing as far as a model right now based on coronavirus, but coronavirus is not always going to be here, right? Let's fast forward years down the road. If it's something that you're interested in, I look at it as a higher reward and higher risk and more active strategy than simple set it and forget it rental property investing with JWB. JWB, we sign long-term leases, right? We want people to be in the home for a very long time, right? We are not going to get those incredibly high rent rates that you can get in season for a vacation rental or in season for, a student lease. But what we're also not going to have is the turnover and the additional headaches and the amount of tenants that you have, right? It's a more consistent, more passive, less risky, potentially less rewarding from, sometimes you can get really high rents for vacation rentals and really high rents for student housing, but there's just more risk that goes along with it. So I think it goes back to why you're investing. If it's something that you want a little bit more risk, a little bit more reward on a cash flow basis, but you're willing to take more headaches, then that might be a path for you. If not, the simplest, the consistent, long-term leases, great management in place. You don't have to check your account, every single month and whether if the rent's going to be there or not, or what happened with the lease. Then you go to a turnkey model like JWB.
Got it. So let's talk then apples to apples in the bigger markets in Florida, right? Like when I think of the major markets in Florida, I think of Jacksonville, I think of Orlando, I think of Tampa, and I think of the greater Miami area, which is kind of like West Palm down to Miami, right?
Mm-hmm.
What is the difference between investing here and investing in those markets?
Well, I think, again, it goes back to what is important for you as an investor, right? The number one goal for making a decision to invest in a turnkey property is that you should be able to get positive cash flow. And the best way to determine if you're going to be able to get positive cash flow in a market is to look at low prices to find high rents first, right? Because that's what creates your cash flow opportunity. If you look and you see prices in your market that are below the national median, that's a great sign, right? That means that there's a good chance you're going to be able to find positive cash flow, but you can't stop there, right? Then you need to be able to find those same markets, those same, call it handful of markets out there. Then you have to be able to find those markets that also have high rents. So the first thing you're looking for is low prices compared to the national median. The next thing you're looking for is higher rents than the national median rent. And if you can find that, that's where you target as your kind of your first step towards finding a cash flow positive market, right? Then after that point, and only after that point, do you then look for long-term historical appreciation, right? Number one is cash flow. Then you can look for appreciation. These other markets you're talking about, Tampa, Orlando, Miami, if you look at their prices, they're higher than the national median, right? Haven't looked into their rents, but I can tell you that their rent to price ratio is not as great as Jacksonville. Appreciation is really high, just like Jacksonville's is, right? Jacksonville's long-term appreciation rate is 4.3% on average per year ever since 1991. I haven't looked into those specific markets because they don't meet rule number one for me, right? You can't get positive cash flow there by and large, but I would imagine they have high appreciation as well. And so it just misses out on the number one rule, which is positive cash flow. And it's so crucial that you stick to that rule first, right? That is your entrance into this game because that's what creates assets that pay for themselves, right? And for many of you who are listening and you're interested in rental property investing, you're not interested in just doing this for one property. You want to own 3 or 5 or 15, right? Well, what's going to give you confidence to take on 3 or 5 or 15 assets is when these assets pay you every single month rather than you paying for them, right? That's what a simple definition of an asset for me is. When I buy something, does it pay me more each month than I have to put out in expenses, right? Well, that's how you get confidence to build up a portfolio of 5, 10, 15, maybe hundreds of rental properties like I own. It's because they pay for themselves every single month. So the one of the challenges was going to some of these other markets in Florida is you just don't see that. Prices are too high, rents aren't high enough, and it's hard to find positive cash flow in a neighborhood that you want to be investing in.
Yeah, that makes sense. I'm not as much of an expert, obviously, in the numbers, and I haven't looked at it like you have, but I have a wide network of friends, especially, particularly in South Florida, and then a big grouping in Tampa. And I know that my experience in South Florida was the affordability of housing is just through the roof, right? I would call it the equivalent of gambling at like the $500 per bet blackjack table versus the $20 per bet blackjack table, right? And the idea that you have to be so into a property that regardless of the rent or whatever, it didn't make sense to me, which was one of the reasons I left that city as much as I loved it, right? Like to find that.
Absolutely.
And then anecdotally, right, I'm hearing kind of the same stuff in Tampa from my friends. I think it's at a different scale, and they talk about unaffordability. I don't think they're talking about the prices in Miami, right? Like I was looking at like 1-bedroom apartments for $400,000 in an area that I didn't really particularly want to live in. Right?
Yeah,
That's crazy.
it's crazy.
So
You get to Jacksonville,
uh-huh.
and you can be literally within a bike ride of the beach, and you can still be spending, $400,000 on a house, right? You go to Miami, it's in a bike ride of the beach, it's a lot more than that, right?
Yeah.
Jacksonville is really just an unkept. It's a well-kept secret. It's becoming less well-kept as far as what you can get, because you just can't get these types of amenities, these types of kind of natural assets that you get in Jacksonville, and also get all the positives of the state of Florida with no state income tax and the weather and all this good stuff, population growth. Jacksonville's special. So, you go there, and then, something else just to talk about too is the way that jobs are created and the economic base that we have here in Jacksonville compared to other markets. Again, not trying to take a cheap shot during coronavirus time, but when it comes to Orlando, we talked about this well before coronavirus time, right? It's heavily tourism based. It's a little bit more risky and a little bit more potentially there's some rewards there because, things can really boom and all that. But, at a coronavirus time, it's really hard for the Orlando market right now. Jacksonville's not, right? We are not tourism based. We are military, we're logistics, we're shipping, we're finance, and those jobs have been able to hold up very well during coronavirus time, but they hold up all the time. Yeah. Right? It's not seasonal, it's not dependent, it's not as risky as a job base. And those other markets have a lot more tourism than Jacksonville does.
Yeah. Yeah. And Lonnie is in the chat adding some really good context, right? He's in Orlando, and he's talking about it depends on people's models. Some people rent bedrooms, so not all income stops, but that again alludes to a more active investor if you're parsing out bedrooms. And he also put here, I live in Winter Park between Full Sail and Rollins colleges. There were a couple houses rented to college students in our neighborhood. One was across the street from me. The house was never empty. We called it the Bro House. The house rents for $2,000 per month regular rental. Again, great rental rate. It comes with some bros, right?
There you go. Winter Park actually is where I was born. Winter Park Hospital. That's where I was born. I know that area very well. And yeah, none of these are bad models. You just got to know what you're getting into, right? It will work for some individuals. If you want to be passive, it's probably not the best one for you, but it comes down to what your priorities are.
Yeah, makes a lot of sense. Right now, we're going to get into user generated. I want to acknowledge everybody that's saying hello out here. Malachi, hello. Eddie, hello. Lonnie, good to see you. Lee Bishop, Roldan, Marilyn is back. Love having Marilyn. Jake, second time, right? He came for the first time with a Doug call. I see you again, Jake Hargrove. Good to see you, buddy. And am I missing anybody else here? Bill Shields. I think I said hi to you earlier, but welcome back. And Vinay, of course, Vinay. Welcome back, Vinay. So I'm going to get into, we had promised Roger Evans, who I see back here again. Welcome back, Roger. You had asked this at the end of the show on Tuesday, and we want to keep our promise, right? Roger Evans asked, is it advisable to purchase a home that is on well and septic for rental purposes? Does it cost more to maintain?
That is a fantastic question, and it's going to lead right in. I know, what we're trying to do more is I'm trying to show you real assets that you can purchase on a weekly basis. I do this typically on the Friday walk and talks, and I do that. Sometimes clients purchase those right off of the walk and talks, but I want that to be a learning opportunity. So your question is a fantastic one. We'll actually get into that. It might be a good time, Pablo. Do you want to bring up the property that we were going to focus on today?
I do indeed. Give me one
Okay,
second.
because this will help answer Roger's question. So the question is it advisable to invest in a property that has a septic system rather than city sewer, right? And is it going to cost more to maintain? The answer to both of those is yes. so let me walk you through this. Let me kind of set the stage of what a normal kind of property management company or turnkey company does when it comes to analyzing maintenance costs, right? So most turnkey property management companies do not actually track what your maintenance costs are. What they do is they put it onto an evaluation for you to purchase. It might look something similar to what JWB does here, where they give you an estimated maintenance cost for you to factor into your returns. But after that, there's no accountability to that. They don't have the systems, they don't have the tracking, maybe they don't have the desire, maybe they don't want to know what the actual maintenance costs are. And so it is impossible for them to know if it is going to cost you more for a septic system than it is for being on sewer. JWB asked the same question many years ago, but we did something about it. We started to track all of our clients' returns. We compared what we told our clients they were going to earn versus what they have actually been earning. We do this every single month to prepare a report for clients. We've done this since 2011. So that's almost 2,000 investment properties that have been sold, that have been tracked every dollar in and every dollar out. And we can filter it and categorize it by if there was a septic system there, if there was a sewer, and amongst a lot of other things that we can categorize. And we do that. And that's how we prepare clients correctly. So the question, is it going to cost more to maintain a septic system? Yeah, it will. For a renovated home, it will. So let me show you something. This is the property on Lamonto Ave. Now, this is one that we're just making available. And I'll talk a little bit more about it in a second. But to get to the point here, look in the bottom right there where it says vacancy rate and maintenance rate. All right. 3% for vacancy, 6% for maintenance. Okay. What this is talking about is what percentage of your gross rents collected are you expected to have to pay back in either maintenance cost or lost rent that you would have, which is your vacancy cost. All right. And if you look just to the left of that, you'll see city sewer or septic, and this is sewer. All right. So this is a renovation home. And based on our data that we've been tracking, as I mentioned, 2,000 properties since 2011, we've been able to show that your maintenance rate for a renovated property on sewer is 6%. That's what you should expect, right? Over time, that's what it will be, because that's what it has been for all of these properties, right? But if we pulled up a different property, and I wasn't as prepared for it, but if I pulled up a different property that was on septic for a renovation, now I'm not talking about new construction here, I'm just talking about renovations, you would see that maintenance rate is actually 9%. 9% is what you would see. And that is just real. That's just what it costs for a renovated home in a septic tank. You're just going to see higher. The kicker here is these can be great assets for you to invest in. I own many properties that have septic tanks, but you just have to know it going in, and the numbers have to work, assuming a higher maintenance cost, right? So if you look at this property on Lamonto, again, this is sewer, so it has a 6% maintenance cost. You can see you're still earning over a 9% rate of return here, right? For a conventionally financed property, a little over $260 a month in cash flow estimated and over a 9% return. Our investments are geared to generate between 7 to 9% returns. So that's great. And it's got a 6% return or a 6% maintenance cost. Do you know what our maintenance cost is on new construction, Pablo?
Like 2%?
Pretty close. It's 2% vacancy cost and 4% maintenance cost. So when people say, oh, should I not buy a renovation property because there's more maintenance? My answer is no, you should not buy it. You should just know that you're expected to have slightly higher maintenance costs for a renovated property. And as long as you can earn, call it a 7, 8, maybe a 9% return on investment, that's a win. And it's the same kind of thinking when it comes to a septic tank, right? We're going to estimate 9% maintenance cost on your septic because that's what the data has shown us. And if the returns are 7, 8, 9%, including that, that's a win. So you will see septic properties with JWB, but only if they hit those numbers. And it's harder for us to acquire them to hit those numbers. So you see less of them. But we're big believers.
That makes sense. I love the commitment to data, man. Like to me, it's everything. And I see it everywhere, right? From our meetings where you track all every number of like every SEO to lead. It's really cool. Let me ask something. That maintenance rate, 6% of what? Of the cash flow, of the property value?
Yeah, that's a great question. I get that a lot, and I kind of gloss over it sometimes. So I'm glad you asked. It's out of the rent each year. So let's take, you see that lease 2 years, line 25 right there? It says $1,400. We want to follow along at home here. $1,400 times 12 months is your total rent for the year is $16,800. All right. Then you take 6% of that, and you should be expecting to spend about $1,000 a year in maintenance cost on this property.
Makes sense. And this 263 number, this is cash flow after all costs. What does that exclude?
Let's go over to that tab on the far right there. It's analysis. 2 more over. Yeah, that one. All right. Yeah, let's go to that one there. And I'll show you, I'll break it down. That's actually a great spot that, you can go a little bit farther down low there. All right. So that monthly column E there is what we're looking at. That's how you generate that. I think it was 260 for costs there. All right. So on a typical, what we're trying to show is on a typical month, how much cash flow is going to be generated, right? Because there's 2 things that are important to folks. How much is cash flow is going to happen on a normal month? And then what is my overall rate of return? So for this cash flow question, we're just focusing on a normal month, right? A normal month doesn't have some of the negative items of vacancy cost or maintenance cost, doesn't have a tenant placement fee. You don't have that every month. But it also doesn't have some of the positives like your principal pay down. You're not going to see that in your bank account. You're not going to see your tax savings every single month in your bank account. So this is just really what's going to hit your bank account. And so if we just go right down the line there, for this home, you're going to earn $1,400 a month in your gross rental income, which is, row 18 there, right? And just going down the line, you're going to always pay property taxes. You're always going to pay insurance costs. There's no HOA dues on this. You're always going to pay your property management fees as we collect rent for you. And so what you're going to get is your total expenses there. So all of that, you take your gross rental income minus your expenses, and then you drop down to line 34, which is your NOI, your net operating income. All right. The only thing we haven't talked about is what your principal and interest payment is on your mortgage. So you subtract that out. That's that $752. And then ultimately, that's how you get roughly the $260 in cash flow on a normal month for you with this asset.
Okay, that makes perfect sense.
So let's keep it there. Keep it there for one more second, though. All right. So I think a good question should be, well, what about maintenance cost? And what about vacancy cost? And what about tenant placement fees? And what about the tax savings and the principal pay down? That's where we start to look at that year 1 column there. And if you look at the very bottom of that year 1 column, it's 9.33%. Well, that includes all those items there, right? So it includes your tax savings. If we go up from the bottom up, your tax savings, it includes your principal pay down, right? Principal pay down means what the tenant is paying down for you on your loan, right? It includes your full tenant placement fee. This is something else to look for if you're thinking about investing with a turnkey property, a turnkey rental property company. I don't know if I see any other ones that include the full tenant placement fee in year 1. And it would be very easy to justify that you could smooth this out over time, but we did this on purpose. We want people to see the full effect because when people see that full cost in the first year, we want them to line it up to exactly what they see on their evaluation and know that that's there, right? You know, like for example, our average tenant stays over 4 years. It would make financial sense for us to just divide that by 4, right? Smooth it out over a number of years. And what would that do to our cash flow? What would that do to our return on investment? It would jack it up, right? It would make it look even better. But we didn't do that, right? We take the full brunt of it in the first year because it's just really important to prepare you accordingly, right? If you don't do this and then a client comes on board and they're like, well, I didn't expect to see a $1,400 charge for tenant placement fee. I thought it was going to be $400 or whatever it is. It starts off on a negative foot. So we said it's better to be conservative and to make sure that people see that. Along with your maintenance and repairs cost. So that, roughly $1,000 is that 6% cost like we were just talking about. And then vacancy, you don't see vacancy there. And we don't put vacancy there is because In your first year, it is incredibly rare for you to have a vacancy cost because we sign long-term leases. So we start including that in year 2. That's where you see vacancy cost. You don't see a tenant placement fee there because you already paid it in the full one in year 1. And this is the most accurate reflection of what your returns will be.
Outstanding. Outstanding. Mike Foster has a question. Do you allow people like us to have a copy of the quote analysis conv fin spreadsheet tab to plug into our own sample numbers?
100%. Absolutely. Actually, it's available online right now on our website. So anybody can go to our website and just request to view properties. And when you do that, you'll be able to, you'll put your information in and you'll go to another page that allows you just to download them, and they're Excel files. So you can mix and match and change, and the full transparency is right there. So yeah, that's right there for you, Mike.
Okay. And I'm gonna answer. We have a bunch of great questions here in the questions tab. I'm just gonna stay with the ones that have to do with this spreadsheet right now. Bill Shields says, probably a dumb question, but where do the tax savings come from? And Bill, I just want to tell you something. You can't ask dumber questions than me, so don't worry about that. Keep going.
It is hard. It's hard, Bill.
It's hard.
It's very hard.
Yeah.
I'm just joking.
So where do the tax savings come from?
That's certainly not a dumb question at all. That's a pretty confusing topic. So when we're talking about tax savings, we are talking about your federal income taxes. And one of the most beautiful things about rental properties is the way that the IRS allows you to depreciate your asset. So when I say depreciation, I'm not talking about home price depreciation or appreciation. I'm talking about the fact that things break over time, and the IRS allows you to take that into account and to write it off. And so the simplest way to look at it is to know that the IRS allows you to write off the value of your building over 27 and a half years. And so what we do to generate that tax savings component is we look at the value of that write-off. We figure out what the write-off value is based on your purchase and your building value. And then we assume that you're in the 30% tax bracket. And if you know the value of the write-off, and you know what tax bracket you're in, then you're able to numerically see how much money you're saving on taxes because of this write-off. And what this does, especially in Jacksonville here, a lot of times, the income that you earn, the passive income that you earn, the positive cash flow, is offset by this additional write-off that you have, this depreciation. And when that happens, basically what you're doing is you're deferring paying the taxes. And for all of our friends who love tax savings, right? When we talk about deferring taxes, we often think of 401ks or IRAs, right? These are great ways to defer taxes. Well, you can also think of an individual rental property when you evaluate the fact that your positive cash flow is offset by this depreciation write-off. That's almost like it's almost like a little mini tax deferral plan as well. And it's a beautiful thing. That's why your accountant tells you to go out there and buy rental properties from a tax perspective, right? It's one of the reasons why. It's why a lot of savvy investors buy real tangible assets like rental properties, because of this tax savings component. So when you see it on that evaluation, Bill, and if you have questions, Bill, you can just reach out or request the properties online. We'll get those to you, but you'll see a tax savings component, and that's what's reflected there is the amount of taxes you don't have to pay today because they were deferred by the write-off from depreciation.
Okay. So I'm gonna continue down. We're still on this topic. Eddie Harris asks, there are no tax savings with non-recourse loans, correct?
So that's a great question. He's asking if there are tax savings with non-recourse loans. I would take it a little bit of a broader, right? You get a non-recourse loan when you're investing largely in your retirement accounts. Mm-hmm. So there are no tax savings, no depreciation write-offs when you're investing in your retirement account, right? I'm going to try to put you on the spot, Pablo. Why do you think that is?
Because that's already deferred.
Nailed it, brother. Nailed it. That was awesome. Good job. Right? You're already getting it.
I'm getting it.
It's already deferred. So
yeah.
You're there. So you're right. You don't get depreciation because you already have the deferral of your taxes in a 401k or IRA or any retirement account there. It's not specifically to non-recourse accounts. Technically, you could do a non-recourse loan outside of your retirement account. You just typically probably wouldn't do that because the interest rates are higher and you have better rates going conventionally if you're outside of a retirement account.
Got it. Before we transition here into other things, I got one question. Why haven't we been doing these property breakdowns during Q&A? So, like, I feel like I'm learning so much, man. What's going on? Like, where were we with this stuff? Comment in the chat, right? Like, I feel like we weren't doing this stuff because we don't want to be salesy, but I think this is really educational, right? Like it really opens the top for people to ask, right?
This is great. We get so much value out of when you guys are so engaging and interacting and asking really great questions. When somebody asks a questions like Bill asked about that estimated tax savings question, guarantee everybody else on the call had that same question, right?
Yeah,
And
totally.
and we appreciate it. So the more you guys ask questions and show interest, we're going to keep doing it. And it seems like this is a win.
Okay, yeah, we're getting some good feedback on the spreadsheet breakdowns. So we're right at that half an hour mark where that is what the calendar invite says. So I feel obliged that if you got to get going, right? We are having another show Tuesdays and Thursdays, right? We want you here. This Tuesday is actually, we're having Monday is the client investor only State of the Union, what we've learned in the first 6 months of this economy and what we see going forward that we're going to have. And then we're going to share that stuff and share the information that we shared here on the Not Your Average Investor show as well. So I think it's going to be a really valuable one. I hope everybody shows up. And if you haven't registered, everybody here's registered already because you had to be at jwbshow.com to be here.
Well,
But
actually,
no,
no, this one's going to be different. So this one has a special registration link because this is only for clients.
okay.
So this is a client only call. We do these about every 6 months or so, or whenever the time is right. We did it once when coronavirus hit. And so, yeah, we want to make sure that we give special space for all of our clients. We had over 200 clients that joined the call the last time that we did it. And we just didn't have enough time to answer all of the questions that we had. So that's why we limit it to clients. We want to make sure that they get the message first. And so that's what we're doing on Monday. For all of our clients that are on the call right now, you will be getting an email today if you haven't already received it with a special link, and we would love to see you there. And then Tuesday will be our normal Not Your Average Investor show.
Correct.
And that's the one, since you guys are here, like Pablo's talking about, you don't have to re-register because you're already registered for that. We'll just make sure that we give you a text message about 30 minutes ahead of time to remind you so you can come and hang out with us.
Yeah. And it'll be a recap of that meeting, right?
It will. So what we'll be doing in both meetings really is focusing about the first half on the Jacksonville real estate market update. We're going to be having my business partner, Alex Safakis, joining us as well. And it's going to be a really insightful. I know Pablo and I already saw his Jax market presentation that he does to our team internally. Really interesting information that you're going to see if you're a client on Monday and for everybody on Tuesday. So you definitely don't want to miss that. And then what we're also going to do is give you an update on JWB company initiatives and other things that are going to help improve your return on investment. And so that's going to be the two halves of the call. And I think it's going to be very, very insightful. And I think it'll be really well attended. So we're excited to see you all there.
I heard that the Monday call is going to have a wild card and that you have a new moderator for that call. Is that true, Gregg?
We do. We called in the closer here. Called in the closer.
Give me Vaughn.
Pablo's going to be hosting the call on Monday, and super excited. I mean, one of our goals has really been to make sure that we're linked between everything we're doing on social and all of our clients, because there's tremendous value. You guys have let us know there's tremendous value in what we're doing on our Tuesday and Thursday shows. And sometimes I have felt like our clients weren't always there, right? And I think it would be wonderful to have sort of a happy medium of clients and whatnot. So hopefully this is going to be a great stepping stone for some of our clients to get more familiar with you, Pablo, to get more familiar with the format of the show, and to keep bringing value and to keep seeing our numbers of engagement continue to rise. It's always great. I mean, we have such a great group, especially here on Thursdays, and it just keeps growing slowly, and that's the way we want it to grow. It's people that really enjoy being here. It's not like a flash of a huge amount of surge of clients and they aren't there the next day. We want this thing to grow organically, and that's what we're seeing.
Yeah, with real relationships here, right? Like I feel like I'm friends with everyone that's in this room, right? Like it's pretty awesome. So I also got really distracted to also just prompt the whole, if you want to go to the JWB web class to understand it from top to bottom, if you're new here and you just want to get a primer on it, I highly recommend it. And don't forget that if you have a specific question, if you want to get in on that client call for next week and you're not a client yet, you got to go to chatwithjwb.com. Just saying.
That would be a quick turnaround. I will tell you.
I mean, can they put like $10 on a down payment or something like that to get in on the call?
We'd have to speak like the Micro Machines man guy on our calls. Yeah. We might have to do that. I don't know if that'll work for everybody.
The Micro Machine guy. I remember that guy perfectly. All right, so let's get into our Q&A panel here, which is awesome. So Lee, this isn't a question, but I'm gonna read it because Lee's the best. Gregg, you and Doug really led us behind the curtain on the startup process. Really informative. Doug had some real creative financial strategies to getting started. Everyone needs to have a rental property asset class in their portfolio. Great stuff on Tuesday. So that's just a shout out to our Tuesday show. We had Doug Orr on, who is a real estate investor that was working in a Honda factory just 6 years ago and was able to get financially independent in 3 years. I thought it was a great call. Gregg, you enjoyed it?
Tremendously. It was like looking at myself when I was, now he's really successful. So he's gone through some of these stages already, but at every stage you get to see where that person is and the level they get to. And it wasn't just the success that he had, the humility that Doug had, I think was just really transparent and makes you just want that guy to keep growing, keep doing better. You want people like him, leading this industry. Right. And so it's exciting and really cool to have that relationship. I'm excited to give him a little bit of help as well.
That's cool. Cool. All right. So Eddie Harris has a question. Hey guys, at the end of a lease with JWB, when the tenant decides to re-up, do we pay additional new lease fee?
Yes. Great question. So you are going to pay an additional lease fee of $200 for every year that we re-sign. So we re-sign 1, 2, and 3 year leases. So if we re-sign your resident for a full 3 years, that would be a $600 charge. If we re-sign them for just 1 year, it would just be $200. This is one of the best things that we can do for you to increase your return on investment. Most property management companies don't focus on lease re-signs. They don't track them. They don't measure them. They don't really care about them because ultimately when they re-sign a resident, they don't make as much money as when they put a new resident in. But for us, our job is to increase your return on investment. If we do that, you're going to be happy. You're going to come back and buy more houses with us. You're going to tell your friends and family about us. That's how we all win. And so my team has a goal of 70% of residents to renew, which is insanely high. Most property management companies can't do anywhere near that. And so that's where we are for this year. We were there last year, 70%. The goal used to be 65% a couple years ago and continue to get better and better and better. So yes, you will see a small fee there, but look at the overall return on investment there. So let me kind of break that down. If a resident leaves, right, the costs that are coming to you, your additional vacancy cost, right, the lost rent, call it 2 months of lost rent, right? Then there's the cost of what it takes to put the house back into rental shape, right? Might be a couple $1,000s out of your pocket to put it right back into rental shape. And then there's the new tenant placement fee that a property management company would earn when they put it back into your, put a new resident into the home, right? So you're talking easily about, $4,000, maybe $5,000 of a true cost total for a turnover. And so that's why you need to work with a partner who understands how important they are. And obviously there's a lot of time and effort that goes into it. So the cost really for us is very small compared to the amount of effort that we give into it. And that's why everybody wins.
Sounds good. Sounds good. So John Evans has a question, which I think he retracted, but I'm pretty sure that people have this in their head already, right? So let's get into it. This is the tough one, Gregg. We talked about it this morning, right? John is asking, could you comment again why you don't feel that the coronavirus will not cause rental prices as well as housing prices to drop? 2008 housing bubble caused 30% drop in housing prices, but rental prices were not affected much. But this time I believe / fear that the economic consequences with job loss will be severe, with jobs not coming back for some time. This will increase demand for rentals, but as folks leave homes, they become rentals. Won't this require rents to fall in order to keep your rental rented?
Great question. I think it's on the minds of everybody. It was on the minds, especially when coronavirus hit. It kind of subsided a little bit, I think, with everybody's general kind of like, this is the new normal thing. But now with the spike in cases again, nationally, right, it's causing fear. Anytime you have fear, let's go to the numbers. It's great that we have numbers, not just what's happening right now as far as rent collection, but we also have numbers historically. So especially when we're referencing what happened in 2008, we kind of start there. So let's talk about housing prices first. The way that housing prices react is really due to supply and demand. The best metric to track this is called months of inventory. Months of inventory tracks the number of houses that are on the market compared to the number of houses that sold in the previous month. And we started tracking this metric in 2014. Historically, in an equilibrium market is between 6 to 7 months of inventory. And an equilibrium market would give you average historical home price appreciation, which is
4.34%.
nice, 4.3%, right?
Yeah,
That's what
right.
the average historical appreciation has been in Jacksonville. It's not always going to give you exactly that, but that's generally what you would see over time for markets that have 6 to 7 months of inventory. And it's a leading indicator maybe over the next 6 months to 12 months. In Jacksonville, since 2014, we haven't been above 6 months of inventory. Over the last few years, since 2016, we haven't been above 3 months of inventory, right? Right now, I don't want to burst the bubble too much because I know the stats on Monday that we're going to release, but it's lower than 3.
Wow.
Months of inventory is going down.
Wow.
Right? So it is about supply and demand. So the reason why you're not seeing housing prices go down, in fact, why you're seeing housing prices go up is because of supply and demand. It's because of low months of inventory. And really, John, that should give you a lot of confidence to know that even though coronavirus is hurting the number of home sales, the number of available listings is also down. And we have such a long runway before we would get to 6, 7 months of inventory that it would take a lot to see housing prices decline, is the way that we feel about it. Taking it one step farther is, I invested in 2006. That's where I bought my first 40 rental properties at the absolute height of the market. I then watched as those housing prices fell 30%, 35%, just like you referenced. And the beauty of rental property investing, John, is that when you invest for the long haul, markets tend to repeat themselves in terms of home price appreciation. If you invest for a full market cycle, which is what I recommend, it's what I do, then you're going to have confidence to know that the values are going to come back and that average historical home price appreciation plays. And so just to give you some data to back that up, if you look from 2001 to 2020, a full market cycle in Jacksonville, which saw the huge spike and then the huge drop that you're talking about and the subsequent gain again, our average home price appreciation for that market cycle is over 4%, just like we're talking about. So hopefully that gives you a little bit of confidence, some data support why we don't see housing prices going down in the near term.
Great. So that answers the housing prices. So there was a component there to vacancy, right? Like, what do you think about that, Gregg?
So, rent collection was everybody's concern in the beginning. When coronavirus hit, when we did this show and we were talking about it, Pablo and I, and I'm like, Pablo, I'd be lying if I said exactly that I knew how this was going to go. I think people would see through that immediately because nobody in the world had been through this yet. And I knew that owning rental properties is a consistent asset class, but there were still so many unknowns. And we saw what would be mounting job losses, unemployment. We didn't know what stimulus package was going to be there. And we just didn't know. So I prepared everybody to expect a short-term temporary loss of rental income, to be ultra conservative, because when I looked at myself in the mirror, that's kind of what I expected with my assets. It has not turned out to be that way. A normal month for JWB is a little bit over 98% rent collection. And we are just about there. Pablo, you know what? I checked the numbers before. You know how I was saying it was 97.5% in April, and then 97 and I think I said 97.8% in May. We actually hit 98%.
Wow. It's amazing.
In both of those months.
Yeah.
Yeah.
Wow. Okay.
Yeah. So our rent collection has been incredible. Now, what has been helping that? Okay. Stimulus package really helped that. We talked a lot about this in the beginning, that additional unemployment benefits was going to have a tremendous impact on the ability for our residents to pay rent. So that's absolutely had an impact. There's a lot of other positive things that have had an impact: our team, our relationship with our residents, coming up with solutions, all that good stuff. But that certainly had an impact. So, kind of maybe jumping into maybe another question that other folks have is, the stimulus package is expected to end at the end of July. Well, it is going to end at the end of July. Foreclosures and evictions, the moratorium on those in the state of Florida has been extended through August. what gives us the confidence to know that people are still going to be able to pay rent at a high percentage without knowing if there's going to be another stimulus, right? I would imagine that there probably would be, but we don't know. And one thing that gives you a lot of confidence to know is that the unemployment benefits, that $600 a month, is ending at the end of July. However, they have extended unemployment benefits to go a lot longer than what they were originally through the CARES Act. So they're still in place. And generally, depending on the state, you get between 40 to 60% of your overall income when you're on unemployment. This goes back to a question that we had in the group, I think last time, which was about our tenant screening. You know, would we relax our tenant screening? And the answer is no. We think our tenant screening is one of the things that sets our clients up for success and sets us up for success. Part of our tenant screening is that you have to make at least 3 times the monthly rent in order to be able to get approved to rent a home. So that would be a third of your income. So, you know, there is still unemployment benefits coming. Now I'm kind of painting a worst case scenario. Let's say there's no stimulus coming down the pike, which I don't really think is my personal opinion. I don't think that's going to happen. But if that happens, you screen your tenants the right way. You make sure that they don't have a high percentage of their overall expenditures going to rent. You know, you don't have 40, 50, 60% going to rent, and you're protected even when people lose their jobs, assuming they're getting normal unemployment. Many will be able still many will be able to pay rent. So that gives us a little bit of confidence there. As always, this is a very fluid situation. We're going to be monitoring all day, every day. And, you know, I was telling people that in April, when this whole thing broke, and the end of March, when this whole thing broke, I had never checked our daily rent collection stats before. And I did it for a long time. My business partners and I did. I haven't done it, you know, in the last month or so, but you know what? This end of July, this moratorium that gets extended through August, it's a good time for us to be hyper vigilant again. And, you know, we'll figure it out. We always do. The best companies figure out a way to do this. And rent collection, not just at JWB, has been strong. Rent collection in this entire space. The other movers and shakers that I talk to in property management, single family rental property, rent collection has been very, very strong. So I don't have any concerns.
Okay, great. I think that was a all-encompassing question, all-encompassing answer. Lee Bishop has a question. Gregg, do you know how many the average JWB rental client? I need to reread this. Lee Bishop asks, Gregg, do you know how many rental properties the average JWB client owns? And I know in my case, I want to have at least 20. It's a nice flex, Lee.
Yeah, you know, our highest number of properties, I think it might be 16 or 18 would be our client who has the most at the moment. Our average is somewhere around 3 per client. You know, bringing new clients on, and sometimes clients purchase 1 or 2 in the beginning, gives them some time to ramp up. So, you know, that average number of properties owned per client has continued to grow over the years, which is a really satisfying measurement for us to see. It's, you know, we put a lot of our efforts into our experience for clients, and, you know, the win for JWB is that you come back and buy more houses that way. And we want to spend a lot of time and energy and effort doing that. And we think that's the best way to spend your quote unquote marketing dollars, is to do that. You know, that's why we call all of our clients every single month to be able to discuss their portfolio with them. We do a whole lot in the background that you guys will never see. And so we do that, and we want to see that number continue to grow over time, and it has been.
Makes sense. I know that in our conversations, you always tell me that you want everybody to get to that 3 number because it diversifies you in a healthy way. And then in my conversations, because I don't shut up about JWB, to my friends that have had rental properties outside of JWB, they always talk about all these pain points that it sounds like JWB handles behind the scenes that ensure that people want to keep re-upping in this asset class. So that's cool. All right. Mike Foster, just out of curiosity, do you permit your own JWB employees to purchase the very same homes offered to JWB clients? Yeah,
absolutely. We love to encourage that.
That's an easy one.
Mm-hmm.
Eddie Harris asks, what is the average cost of a rental in the Jacksonville area with JWB? Thanks.
So the average price will be between $160,000 and $200,000. The median home sales price in Jacksonville is $250,000. So you're below middle income is right where you want to be. And that's for a new construction house, 160 to 200,000. For a renovation, it might be slightly less, maybe as low as maybe 150,000 or so. They're a little bit lower on the pricing scale. But yeah, that's where you should expect it to be. About $40,000 at a minimum for out of pocket is what you should expect, assuming you're getting financing.
All right. Deborah Evans asks, and she qualifies it with another dumb question. Again, Deborah, I am the dumb question asker here. Explain principal pay down as a part of ROI calculation, please.
Yes, great question, Deborah. So, every time we talk about rule number one with investing in rental properties. Pablo, what's rule number one?
Cash flow.
Cash flow, right? When you're getting positive cash flow, that means you're earning more in rental income than your expenses hit every single month. One of your expenses, and the biggest expense for you, is your mortgage payment. All right, so if you've got more income coming in than it takes to pay the mortgage payment, that's a great thing. And then when you look at your mortgage payment, it's not all going to the bank, right? It is going to the bank, but the interest component is profit to the bank. But part of it is just repaying the original loan that you have with the bank. It's that amortized loan, right? So it might be, a couple $100 a month out of that $800 payment to the bank that you're making will be your principal component, right? And so again, if you have positive cash flow and it's more than covering that principal and interest payment, and then it's paying you on top of that, you can also look at the amount that you're receiving and paying down your loan as another profit center for you, because that's simply paying you back. It's increasing the equity in your property and decreasing your loan balance, and your tenant is paying that for you. And it's really, really impactful over time. So, and if you want to see the numbers on it, I would really encourage you to go to the website, request to view properties. It's very simple. You just put your first name, last name, phone, and email in there, and we send it right to you. And then you can look at this yourself, and it's all based on just an amortization schedule, which, you could even do that online. You can go anywhere and put in an amortization schedule, and you'll see how much each month of that 30-year loan, how much actually goes to your principal pay down. And the concept here is your tenant is paying that down because you have positive cash flow here.
All right. Great answer. Harold Litfin asks, what financing would you recommend if you wanted to buy 3 to 4 additional properties all at once, but already have 5 properties with traditional mortgages?
Hey, Harold, great to hear from you. Great client. In fact, I met Harold in person many years ago at one of our events. So good to hear from you, my friend. What financing would I recommend? So you've got 5 properties on your credit, it sounds like right now, and you'd like to buy 3 or 4. You're in a great spot. You really don't run into many financing challenges from a conventional financing perspective until you get to about 10 until you get to 10 properties. That 11th property on your credit means that you can no longer get conventional financing backed by Fannie or Freddie. You have to go to other products, and those other products have higher terms, higher interest rates, not as advantageous terms, but you're not there. If you've got 5 and you want to add 3 or 4, just reach out to your portfolio manager. We'll get you connected with the lender. It might even be the lender that you've already used to purchase your properties with us. And you should be in a good spot. I mean, interest rates are incredibly low. I'm going to do I do a walk and talk every day in our group where I go live and I teach on some aspect of rental property investing or Jacksonville or whatnot. Today, it's going to be about why this is such a big buying opportunity. I'm going to be focusing on interest rates. Interest rates and the ability to secure inexpensive, smart debt is incredibly important. It's going to pay you literally for decades if you can secure loans with, call it 4% interest rates. 4.5% is what we prepare our clients for right now. So getting back to Harold's question, you shouldn't have any challenges there. I'm assuming everything else on the credit profile is the same as it's always been. And you'll be in a good shape, man.
All right. Good stuff. Rob Jones asks, Gregg, can you dive into how you compute a financial freedom number? On your webinar, you gave examples of a couple's financial freedom number is, say, $10K a month. So you compute the rental portfolio to need X number of rentals. Is that computed by cash flow or ... question mark?
Such a good question. This one, I would really recommend, and I'm sorry, I didn't get the name of the gentleman who asked.
Rob Jones.
Rob Jones. Rob, I would really recommend you get on the phone with my team to talk a little bit more thoroughly about this. This is a pretty detailed discussion, so I'm going to give you kind of a high level overview of it, but I would really encourage you, if you have more specific questions to build out your plan, go to chatwithjwb.com. So how do we build this out? And I'm glad that you watched the webinar that I put together. I really think you guys should watch this if you haven't yet. It gives you, really tried to kind of break down the things that I think would prepare an investor who might not be familiar with investing in rental properties yet, the things that you should look for, the things you should learn, and how you can start to actually strategically build a portfolio that can accomplish a goal for you. And so what Rob's talking about is on the webinar, we break down a client who had a goal of sailing in the Great American Loop. The Great American Loop's a great way for for avid boaters out there to go up the eastern seaboard, to go all the way around the Great Lakes, all the way down all the rivers, the Mississippi River, and come all the way back. And it's like 6 to 9 months of being on a boat. And we had a client that was their goal, and we wanted to help them get there. And so whatever your goal is, we're going to help you break that down into a passive income number. So his question is, how did we do that? Well, in that example, I believe the goal is $8,000 in that example. And so we broke it down that they needed 10 properties to be able to accomplish their passive income goal. All right. The way that we get down, that's $800 of free cash flow, of net cash flow for every property. And that's assuming that your properties are paid off. All right. Now, I'm a big proponent of financing, right? So I'm not assuming that everybody's going to buy their properties free and clear. That's not how these clients bought their properties. But when we're talking about establishing the right number of assets in your portfolio, if you assume that everything is purchased free and clear right off the bat, that's the minimum number of properties you would need in your portfolio. And so that's the first milestone that we focus on. So their goal is $8,000 of monthly passive income. And their goal, as we know it today, is to be able to buy 10 properties in their portfolio. I think they're at number 8 right now. And so that's the first milestone. But, the reality is we don't know enough. You don't know enough right off the bat to know exactly how we're going to build this plan over time. We chunk it out. The first goal is to get the right number of assets in the portfolio. And when those clients get to 10 properties in their portfolio, we're then going to have a great discussion. We already having the great discussion of what do we do next, right? Do we start to focus on principal pay down and maybe taking, the bonuses that you earned at work and start to paying those loans down more aggressively? Or do we take those bonuses that you earned at work and maybe increase the number of assets that you want? Maybe the goal then becomes 12 or 13, right? But we know that it can't be less than 10 because that's the amount of cash flow that you would earn if it was owned free and clear. So hopefully that gives you a little bit of insight. And again, I would encourage anybody who has an idea or has a question about how you can build a plan strategically to ride the Great American Loop or whatever your goal is for you. We can build that out for you. It's what we love to do with all of our clients.
And again, Rob, so to hop on a call, super easy. Go to chatwithjwb.com, pick out your date and time. And for those of you that were listening to Gregg recommend the web class, that's jwbwebclass.com. We try to make it as easy as possible. So we'll wrap up here on 2 final questions from, and then Lee is asking, where's the webinar posted? So the webinar is jwbwebclass.com. Okay, let's wrap up with 2 questions from Vinay and let's get you out of here, Gregg. I know it's 1:30. Are you good or do you need to go right now?
Let's do it, man.
Okay, let's do it. So Vinay Rogers asks, so to buy a property in Jacksonville, Florida, will we need to open a foreign entity there? And if so, what are the costs associated with filing, income, et cetera?
Great question. Again, it would be wonderful to talk with you on a more personal level. There are some questions we would want to ask, but the simple general answer is no, you don't have to buy properties in an LLC or in an entity. You can buy them in your personal name. If you look at the vast majority of our clients, they own them in their personal names. Especially when I started to buy my first 40 rental properties, I owned them all in my personal name or my business partner's personal names. And the reason why people go to and set up entities is for asset protection, which is great. And that's where that personal conversation needs to happen because we need to understand how important that is for you and all that good stuff and connect you with a lawyer if that is the right route for you. We'd be happy to do that. But you don't have to. And the way I personally looked at it, and this is not the right way for everybody, is again, different people have different risk tolerances, but I wanted to make sure that insurance was there in the event that something catastrophic would happen on my properties. There's a whole lot more ease, and there's going to be less costs when you buy them in your personal name. Financing's easier when it's in your personal name. And so you don't, to answer your question, you don't have to do the entity. You can also buy them in your personal name, and we can work with you on a strategy to be able to put them into an entity at some point as well. So whatever your preference is, we can do it. And so I would encourage you to reach out to our team, Vinay.
All right. And then Vinay's last question is there an income tax associated with income from the rental properties? And also, do you 1099 from JWB to the owners, or is that hands off for you at JWB?
So the first question is your income, rental income, taxable? It is for your net rental income. I'm not going to get too much into the tax side of it, but just really simply think about the positive cash flow that you earn on this. That's taxable according to your federal income tax rate. However, you have a lot of write-offs, right? You can write off taxes, insurance, property management fees, right? You can write off all of these interest costs, right? You can write off all of these things. You can also write off depreciation as well. That was one of the first questions we had here. And so on many properties here at JWB, the positive cash flow that you earn many times will actually be offset by the write-offs. And so that's the beauty. While it is taxable, that positive cash flow is taxable. If you have enough write-offs to offset it, you don't pay tax that year. You would defer it until future years. And you get those write-offs every single year for 27 and a half years. And then, yes, we prepare a Schedule E, which is typically what you would give your CPA. And so it's very easy for our clients. We give you the Schedule E at the end of the year. You hand that right to your CPA. It's got every bit of information you need to be able to prepare. You can prepare your own taxes that way if you do it. Or you can hand it right to your CPA and you're good to go. No additional work on your part.
Today's call was awesome. Like
it was.
Yeah, right.
You guys are awesome. Thank you for such good questions. This is fantastic.
Yeah. This was really, really good questions. I know John Evans has a clarification of when you were talking about unemployment, there was 40 to 60% of current income. Is that here in Florida? Because in Michigan, it's like 326 a week max or something like that.
Yeah, 40 to 60% is generally across all states. Some are higher, some are lower. In the state of Florida, the max payout is actually $275 per week. So we're a little bit lower on that scale than even, well, I don't know what the income is in the state that he was talking about. But yeah, 40 to 60% is general throughout the country.
Okay, great. And yeah, man, these were great questions. Like, I feel like I really do feel like those property analysis lead us to answering the real questions, right? Yeah.
So that's what we'll do.
Yeah.
We'll do this, and then I'll talk about it tomorrow on the walk and talk as well. And so for all of you who are in the group, you'll get a little refresher there, and we'll kick it off this way, man. I appreciate all of you for helping us discover this.
Yeah, this was this is definitely, it felt like the best questions from a Q&A that we've had so far. Like I really, really feel it. Like I feel it because it's like, I'm learning. These are the things that I haven't thought to articulate. I think it's wonderful. Thank you, everybody, for joining us. We do not take for granted the idea that you spent an hour with us in the middle of your day on a Thursday, but we love it. Like, it really feeds our soul to have these questions, to answer it. I love to watch Gregg shine like this. I'm a fan. I know everybody else is too, I hope. And it's really, really a pleasure. So I encourage you to check out the web class if you haven't. Like Gregg said, little funny story. I watched him shoot that thing, and it took him like 30 tries. He was freaking out the whole time, but I think it ended up really good. So
I had a great coach. Pablo was there the whole time. So hopefully you guys enjoy it, and he deserves the credit there too.
I felt like the guy in the King's Speech that I was like directing you in the background and doing.
I was like,
things.
Did my face look all right? Was I too stressed?
Yeah.
So whatever. It is.
You did it well, man. You did it well. You nailed it, man. And again, for those specific questions, it really is a frictionless thing. If you just go to chatwithjwb.com, get your question answered. Be selfish about it, right? Like don't spend hours doing the research. Let them point you the right way, and it'll be a good use of your time. And that's it. I hope to see everybody on Tuesday. Greg, I'm going to give you the last word as always, my friend.
Yeah, just a wonderful call. Kind of echo what you said there, and just really appreciate y'all being here and excited for Tuesday. Excited for Monday for our current clients. Excited for Tuesday for all of us here, and just really excited about where the show is going. It's been a lot of positive momentum over the last few months, and I really feel like we're kicking it up. And today was another kind of milestone. I feel like we really hit our groove for our Thursday calls too. So appreciate all of you, and looking forward to the next one.
All right, take care, everybody. Have a great weekend.